Good evening, viewers, and welcome to another weekly program of insights and analysis with yours truly on public policy and economic and financial issues in Guyana. Tonight, I want to do a short presentation with you on the recently released financial statements of the oil companies, uh, Exxon and its consortium partners, CNOC and Hess. You would recall those of you who follow the news on a daily basis that there were many commentaries, many articles carried by various sections of the media, and including from some technical people and analysts and political commentators commenting on the profit that the oil companies walk away with. And the view was such that Exxon and its partners walk away with more money than Guyana, as high as four times or greater than the budget. And without doing any proper analysis and applying the formula that is prescribed in the production sharing agreement. So I would have done through our company, we have an analytics company, SPHEREX Analytics. I would have done some analysis, and tonight I want to present that to you and go through the financials and explain the formula and so forth for you to have an understanding of Guyana's earnings, how it is calculated for 2021 versus what the oil companies would have gotten in the form of net profit. Right? So just give me 1 second. Let me pull up this presentation. All right, so I think you should be seeing my screen. All right. Good. So you should be seeing my screen there. So this is the consolidated financial statements, audited financial statements for 2021 by Exxon, Hess, and CNOC. And according to these statements, collectively, the companies would have recorded a gross revenue of $545.086 billion. And this is in for simplicity, and all the numbers that I'm referring to here are in Guyana dollars, right? And looking at the expense items, the total operating cost for 2020 represented 94% of gross revenue, which came down to 42% in 2021 of gross revenue, right? So that gives you net income for 2021 of 314.5 billion. So collectively, for 2021, your companies made an operating profit of $314.5 billion, which represents 56% of the gross revenue. Gross revenue is calculated on the gross production for the year. So what is Guyana's share from that? Now, I've seen persons, including people with, finance people, subscribe to the narrative that Exxon would walk away with $314 billion in profit. That is not true because you have to now apply the formula. And the formula for profit share, remember, the oil companies have to recover their investment costs, their initial investment, which wherein in previous programs I would have explained the life cycle, the exploration costs, development stages, and production stages. And I would have explained that Liza Phase 1, for example, the total development cost is about 4.3 billion US. So that was the initial investment, and it is that development capital investment uh, cost that has to be recovered, right? So the formula is 75% cost recovery, which means you have 25% remaining as profit to share 50-50 between the oil companies and Guyana. So mathematically, there is no way that Exxon could walk away with more than Guyana because Guyana is getting 2% royalty plus 50% profit, right? So the oil companies effectively, all they get is the 12.5% profit, which in 2020 worked out to $22 billion. In 2021, that was $68.135 billion. While for Guyana, in both profit oil and royalty, we got $79 billion, right? So the notion that Exxon got more profit than us cannot be correct, right? If you look at Exxon's, the oil company's statement of financial position, the total asset of these companies collectively is close to 1.2 trillion Guyana dollars. And when, you know, previously, and even though these financials are now published, there is still this view that Exxon employs a lot of debt financing, which means when you have a lot of debt, you have to pay interest on that debt. And so the interest expense would would normally have to be deducted from your profit and loss account. So effectively, interest expense and expenses in general reduces um, the cash profit that remained to split 50-50. So this statement of financial position, however, confirm how much debt Exxon, the oil companies, employ in what you call their capital structure. And that is the when you look at the numbers, when you look at total uh, non-current liabilities, which is the long-term liabilities of the company, it only accounts for about 20% of total equity, which means equity is the capital that the company is put in to invest. They're not borrowing, but it's shareholders' money and money from their retained profits over the years. So the total equity of the company is about $1.1 trillion, and total non-current liabilities is 227 billion. So effectively, there is a low level of long-term debt that is part of the capital structure, just about 20%. So that means 80% of the capital of this investment is in the form of equity financing or shareholders' um, money and retained profits from the oil companies. So that effectively reduces the financing cost. Now, to see to what is the impact of the financing cost, when you look at the finance cost in the profit and loss account here, the financing cost accounts for less than 1% of revenue. So that is, you could say, the financing cost has minimal to virtually zero impact on profit oil, right? That's how low it is. Then there is another lease interest. This is a form of debt financing that is part of the liability as well. And the lease interest also accounts for just about 1.2% of revenue. So altogether, the financing cost of the liabilities, the debt that the companies collectively employ to finance this investment, accounts for not more than 1% in 1% in revenue. So it has a very minimal impact on in terms of reducing profit oil, right? The the other important point I want to demonstrate from the analysis is the decommissioning provision. So recently, we would have seen Tom Sanzillo, the IEFA, and a certain section of the media would have been reporting in the press that the oil companies is deducting from profit oil about 357 million, which is more than what Guyana earns, um, which effectively, based on that interpretation, would reduce the cash profit that we earn effectively, right? And this is a provision, this decommissioning expense or provision is for is to be incurred towards the end of the project life cycle. When they finish producing from the well, they have to um, it is the cost to dismantle and to remove the assets and to restore the environment to what it was before, restoration cost and so forth. So that doesn't happen until towards the end when they finish producing from a field, for example. So, and that's not going to happen until the life cycle for these project runs for about 20 to 30 years. So we're talking about 20 years from now or 30 years from now maximum. But in keeping with accounting rules, strict accounting rules, international reporting standards that these multinational companies are subject to, you have to make provisions annually for that future expense. And the reason for that in accounting is because the asset is being used throughout the life of the project. And the asset is being used to generate revenue, which in turn is used to generate profit. And you earn that profit, that revenue, and that profit every year. So, whatever constitute the expenditure, whether it's operating expenditure, whether it's a future expenditure to to decommission the fields, to restore the environment, those expenditure you can't account for it towards the end when you're using this asset for the entire life cycle. So the accounting rules prescribe that each year you have to make a provision for this. Now it is just like making provision for bad debt, for example. Now, if you have a normal, whether it's a regular business, let's say any other type of business, manufacturing, supermarket, whatever other different type of business, in carrying out your daily transactions, right, to run a business, you can sometimes, if you don't have all the cash and you want to increase or replenish your stocks, you sometimes get credit from your suppliers. Now, that is a form of financing a business because when suppliers extend credit to you, give you goods and credit. You don't pay immediately. They give you time to sell it off, bring in the revenue, and then pay for it. That is a form of credit or a form of financing. So it helps you to finance the working capital cycle of the business while you sell it, and that's how you help. You That's how you're able to grow your business. So you might get probably a week or 2 weeks to pay your suppliers by the time you're selling the goods. Similarly, you would also, because you now have credit from the suppliers, you can also extend the same to your customers, where you sell some amount of goods to them on credit. So in your financial reporting, while your total sales, your total revenue, some of it might be in the form of cash, where the customers pay on the spot for the goods. You might also want to extend good customers, of course, good paying customers, of course, another 2 weeks credit for them. So you give them, say $1 million in goods, and you give them 2 weeks to pay you back. But the full sales inclusive of cash sales and credit sales in your financial reporting is recognized at the time as revenue, even though you didn't collect the cash as yet. So it means customers owe you for that, and they have to pay you. So that amount that customers owe you, credit sales, is referred to as your receivables balances, which would be reflected on your balance sheet as a current asset item. Now, so when you look at some businesses' balance sheet, you might see millions, in some cases hundreds of millions of dollars in receivable balances. So that means let's say receivable balance is 100 million. It means that that is $100 million in cash that you will be collecting or supposed to be collecting, but you don't have it in the business as yet. But it's an asset, you expect to collect it. That aspect of your business, sometimes there are customers who are unable for various reasons, they can't pay you. And so in the accounting rules, you have to make provisions. You have to cater that some of this money you would not be able to recover because whatever reason customers might not be able to pay. So that's bad credit. So you have to make provision for bad debt to at some point in time, right? Based on what is the accounting rules, you'd have to write off that debt. So that is called now provisioning for bad debt. Okay, which is a provisioning for bad debt expense, which would have to be reflected in a financial reporting. Now I'm explaining this view to understand the decommissioning provision now. Now the decommissioning provision, the accounting treatment for is it is treated as a liability. So far, for example, the total decommissioning and restoration provisions up to 2021 was 67.3 billion dollars, but it is recorded as a liability in the balance sheet, which means it is not deducted from the profit and loss statement for 2021, but it is a provision which is recorded on the liability side of the balance sheet. The corresponding entry for that is on the fixed asset side of the balance sheet, where the fixed asset value is increased by the sum that it is provided for. Now, so that is the one part of the accounting treatment. It's a balance sheet affecting liabilities and assets. So that full sum that is being provided for, which is for a future date, is not being deducted from your profit and loss, which effectively reduces your profit, reduces your cash profit. But fixed asset also depreciate over time. So the fact that you have to increase your fixed asset, it means total, whatever is the value of your total uh, fixed asset. In this case, it is 2.3 um, 2.3 billion, 2.3 trillion for 2021 as the total value for the plant and equipment and property. In this case, it would be the FPSO on the full infrastructure set up to produce the oil, those infrastructure, right? That is the cost, the acquisition costs. And so the decommissioning provision is added to that. So it means if you got to add that to that, and every year depreciation expense is deducted to effectively reduce the value over the life of the asset. Um, it means that decommissioning part would also be subject to depreciation expense. So it is that aspect where the asset value goes up by the amount provided for, and depreciation is about is about 14% or 10% or less than 20%. So if we look at the if we go back to the financial statements and we look at our depreciation and amortization expenses for 2021, it's 78.6 billion, which represents 14.4% of revenue. Now, in this depreciation here, this includes some of the depreciation expense for the decommissioning provision. So the point I'm getting at is this decommissioning provision is only at this point in time the depreciation expense of that amount is which is part of the depreciation expense in the profit and loss, um, is deducted from revenue, and if and the approximate um, impact of that relative to um, the gross revenue is less than 1%, right? Based on the amount provided for, less than 1%. In fact, 0.43%, which is reflected based on the calculations. So, what is the summary of this analysis? The summary is, and let me read this for you. The analysis revealed that under the current fiscal regime, within the framework of the production sharing agreement, Guyana's total share of profit oil and royalty for 2020 amounted to about 25.5 billion, which increased to 79 billion in 2021. While the oil company's net take in profit oil for 2020 amounted to 22 billion, which increased to 68.1 billion in 2021. It is worthwhile to note that Guyana's share in profit and royalty is greater than the net profit of the oil companies. To that end, the oil company's share of profit oil for 2021 amounted to 68 billion or US 325 billion, while Guyana's total actual share in royalty and profit oil stood at 85.3 billion or 408 million US, representing uh, $17 billion more or 25% more than the oil companies. The depreciation and financing expenses attributed to the decommissioning provision liability represents less than 1% of gross revenue, thus having almost zero impact on profit oil. Similarly, financing cost represents less than 1% of gross revenue, due to the low level of debt employed in the financing structure of the oil companies. Overall, the analysis disproves the following contrary views of other analysts and political commentators, where one, ExxonMobil or the oil companies walk away with more profit oil than Guyana is far from the truth. Guyana's net take in royalty and profit oil is actually greater than the oil than that of the oil companies. The decommissioning provision is a balance sheet item which affects both the fixed asset and liability side and has a minimal to virtually zero impact on the profit oil. In other words, the full sum of decommissioning provision, which is approximately 357 million US, is up to 2021, is not a deductible from profit oil as has been incorrectly reported and misconstrued by certain sections of the media and other analysts. And finally, the oil companies employed a low level of debt in the financing structure, thus reducing the financing cost for total debt, which in turn has minimal to virtually zero impact on profit oil. So that is uh, more or less a summary of the analysis, which disproves a whole bunch of misinformation being propelled by people from all spheres, commentators, newspaper publishers, analysts, political analysts, and so forth. Now, next week, when we meet again, um, Salim is not here with me tonight, but when Salim is join me next week, we'll be talking about energy security, right? Um, but there's some other analysis that I want to do, which I will share with you the findings, is to show, you know, based on 2021 financials and cash flow position and based on current prices and so on, what would be, now that we know what percentage of operating expenditure, what it accounts for in terms of relative to revenue, we can now calculate what would be the percentage out of the total 75% that goes towards recovering development costs. So we could run another analysis to see when the capital expenditure will be recovered, how long it will take to be recovered, and following that, you know, the profit oil goes up from 12.5% to how much more it goes up to, whether it's 30%, whether it's 25%. But the notion is what will happen is naturally your profit oil goes up when you finish recovering your capital initial capital investment, and that is because you have a low operating profit. And as you can see from this presentation, the operating expenditure for 2020 accounted for 94% of revenue. Now, the reason for that is because in 2020, which is the period during the height of the pandemic, you know what happened to oil prices. Based on the numbers presented, the average oil price for 2020 was $30. The average price per barrel for 2021 was $60, right? So that explained, so the low price and the low production level for 2020 explain the substantial difference in revenue for 2020 and 2021, right? So that is why you had a high operating expenditure, because production only commenced in 2019, right? In December of 2019. So it was in 2021 when they actually made a profit, right? So, and we've seen that the operating expenses went down from 94% of revenue to 42%. And I expect, that will continue to go down as production level increases, right? So right now, for example, in this year, 2020 and 2021, they were only producing from Liza Phase 1 at 120,000 barrels per day. Liza Phase 2 started production in February of this year at, I believe, 220,000 barrels per day. So naturally, the revenue for this year would increase, and which means the operating expenditure would also decrease relative to revenue as a percentage of revenue. So that is my presentation for today. This report will be published in various sections of the media during the course of the week. So those of you who are interested in these type of information, you will look out for them. You'll have access to them um, to read the full analysis, right? I didn't want to present the full analysis to you to overwhelm you with too much of technical details. I just wanted to go through a summary and explain, the bottom line is um, Guyana earned more profit than ExxonMobil. The notion that the oil company is getting more than us is false, and that is proven in these analysis. And it's very simple. You don't have to be a finance person to do these calculations. It's very simple. The formula is very simple and straightforward. 75% of your revenue goes towards cost recovery. That means 25% of the revenue remains for profit oil, split 50-50, and then you have to take 2% royalty as well. Right? So 2% of your gross revenue. So it's simple. It's not rocket science. So with that, I've come to the end of tonight's presentation, and you know, looking forward to having more discussions like these with you next week. So do join us again next week for we will be talking about energy security in a regional context, where of course uh, Guyana would be leveraging its geopolitical importance to lead in that regard, and of course in the context of the gas to shore project, producing energy from the natural gas and the hydro and all of that. All right. So thank you, and thank you for joining, and have a good night.